Stanford University.
Today we're very lucky to have Jeff Clavier and John Lee to come speak to us about funding your startups. Both are very distinguished individuals. Jeff is the founder and managing partner of SoftTech VC, one of the most active seed investors in Web 2.0 startups. Jeff has invested in over 100 consumer internet startups in areas like social media, monetization, and search. Some of his investments include Mint, Truvio, Userplane, Ustream, and Bleco. And he's earned a computer science and research degree in distributed computing. John Lee is a director in Silicon Valley Bank's Entrepreneur Services Group and establishes Silicon Valley Bank's relationships with early-stage tech companies. John assists early and growth-stage technology companies with raising capital through review of investment materials and introductions to investors, including angel groups, venture capital firms, and corporate venture groups. John holds a bachelor's degree in economics from Stanford University and is a chartered financial analyst.
All right. Well, thanks everybody for joining us today. It's great to be here, and I'm looking forward to having a great conversation here with Jeff, and also look forward to having a great dialogue with everybody here, and hope you guys came armed with great questions. Look forward to hearing what you all have to share with us today. So Jeff, it's great to be here with you this afternoon.
Good to see you, John.
Yep. And so what I thought we could do maybe for the next half hour or so is just kind of talk a little bit about the whole kind of funding environment, and from an entrepreneur's perspective, what things that they should be thinking about as far as getting their startup funded. So thinking about things like funding sources, when to go out for funding, what's the current market environment like, and therefore what should they be taking into consideration. So just kind of questions along those lines so that people get a sense of, what does it take to go out and get my startup, seed funded and off the ground.
Sure. I could talk for like 30 minutes about that, so
yeah.
Get me up. So first, it's a pleasure to be here, and thank you so much for joining us. Couple of things that you really want to think about as you get yourself ready for a startup journey. First and foremost is, if you feel like you want to do a startup, that's great, but you have to find the idea, the concept, the product, the service that you're so deeply passionate that you're going to spend the next 5 years or 10 years of your life to actually build it, nurture it, and scale it. And until you have this deep passion, and you're like, yeah, it's kind of cool, and maybe I sort of would like to do that, you will sort of not succeed and go through all the troubles and challenges that a startup represents. So deep passion about what you want to go build is the first thing which I want to see, hear, you scream about when you come and pitch me. The second thing you want to think about is who's going to do that journey with you. Some entrepreneurs can actually do it on their own. We call them solo founders. And we've backed a few solo founders, and we successfully got the companies off the ground and ran them. But it's a really sort of lonely journey to do that. And so we always suggest that 1 or 2 co-founders is really something that you want to equip yourself with, because they can be complementary, they can have the right skills, experience that will sort of complement yours. And if you're, for example, thinking of building a consumer company, B2C, we like to see 3 things out of the founding team. A strong tech background, so that's your tech co-founder, someone who's typically really good at design and product, and someone who's really good at distribution. Sometimes you can find 2 people who have those skill sets, sometimes 1, but typically 3 is kind of a norm. So the concept, the team, and then figuring out from whom you want to try and raise money, and the amounts will be sort of coming a bit later. Mm-hmm. Because of this, you all know, I guess you heard, that capital efficiency now allows startups to really get off the ground for pretty much nothing. You just start putting a few open source libraries together. You have someone knocking off a design. You put that on GitHub. You get sort of a few people to contribute, and you put that in front of users. It doesn't take much. On Amazon, for a few $100s, you spin up a server, and so you don't really need that initial bootstrap funding per se to get something off the ground in front of users. And you will sort of learn quite a bit from those users about how they would use that initial sort of prototype that you've put in front of them. You will learn about some patterns. You can do some user acquisition tests, and then be informed when you come to investors to try and raise some money. Typical sources are actually pretty disparate these days compared to 5 or 10 years ago. You have a few classes of capital. Angels, people who invest their own capital and will put in, 5 to 50 to 100 grand. Micro VCs, which is what the class of investors I'm part of. We're sort of like VCs, except that we have smaller funds and we focus on seed stage. And we'll do anywhere from 100K to $1 million per deal. Then you have our friends, we call them the traditional VCs, even though they don't like them. So David is one of them, very good friend, where if they really like what you're doing, they might actually get involved at the seed stage. Not everyone sort of does that. And this sort of new thing of a few years ago, which has now sort of really bloomed, it's the incubators. So the Y Combinators, Techstars, Seed Camp, Angel Pad, blah. A bunch of people will essentially bring you in some kind of a context where you can learn and get some help from mentors and work with fellow entrepreneurs in some kind of class format or co-working space kind of format, and spend 3-4 months, get a bit of money, and by the end of that 3-4 months, do a demo day where you have you sitting here, investors sitting there, and you pitching your ideas and hopefully getting funded.
So Jeff, let's talk a little bit more about that. So let's assume that you've got a great idea, you've got 1 or 2 folks that you've decided to go and do this startup with, and you're obviously going to put in a lot of your own time and effort to get the product developed, get the business off the ground. At some point, you are going to want to look for some seed funding if you want to scale the business. And as you mentioned, you've got angels out there who have traditionally kind of been the initial source of funding. But now we do have this new class of incubators and accelerators out there. And so entrepreneurs need to think about, okay, well, do I really want to go through a Y Combinator or a Techstars? What are some of the pros and cons about deciding to get involved with one of these incubators? Is it for everybody, or is it for a certain type of entrepreneur?
I think if you feel that, so it used to be the case that incubators were really great for a few, couple of founders who had sort of a concept, either application, business concept, or whatever in mind, but they were not really sort of ready for prime time. They were not sort of, at that point in time, they wouldn't be able to raise money on their own. And so going through the Techstars or YC was a good way to get support from the mentoring team, so either the principals of YC or Techstars or the mentor network, to actually iterate very quickly on the product and within 4 months get to the point of being actually fundable. And it was, I would say, the case until about 2 years ago. About 2 years ago, we started seeing a bunch of companies that went through programs like YC being sort of much more mature than we would typically sort of expect them to be, just because of the valuation bump that they could actually get by going through the program. This whole notion of having 400, and if you haven't been, you haven't been, I guess, to a YC demo day, it's a complete zoo, and we have like 400 investors who are all sort of in the starting blocks and trying to, jump on the entrepreneurs that they want to try and fund, and it's pretty crazy to see that, because typically it's supposed to be the other way around. But the point is that by creating this sort of massive competition amongst investors, it just created a real sort of bump in valuations. And so entrepreneurs started saying, well, if I give 7% to YC, but I can raise $3-4 million at a very high valuation, net off, I'm actually better off from a dilution perspective. And so we started seeing some teams that were just able to raise on their own. They were just doing a better job at the end of YC because of that valuation sort of game. Coming back to the question of should you or should you not do an incubator, my answer is if you feel that you're going to learn a lot and that the team, the mentors will actually be really useful to you, I think it is worth it. We're very close to an incubator in San Francisco called AngelPad, and it's really, it's a great team, ex-Google guys who are putting together a small batch of 10, 12 companies, and typically I'm very impressed by the average level of the teams. We've invested in a couple of those companies over 4 batches, but overall, there's a lot of things that I find they do really well. So if you get into the competitive, incubators, I think it's definitely sort of a net positive. Just understand that it has a cost in terms of dilution. It's up to you to figure out your dilution math.
And then just in terms of evaluating which incubator or accelerator is the right fit, in a way, it's kind of like when you go out and raise venture funding, you want to make sure you partner with the right firm, right?
Yeah, and what's interesting is that recently we've seen, an incubator being announced around B2B startups. Last year we saw Lemnos Labs, which is an incubator for hardware startups. And I like that because it's actually typically harder for hardware startups to get the support they need to get off the ground. And typically it's harder from a capital perspective. You have to actually build the prototypes. You have to have some contract manufacturing sort of experience that most startups actually don't have. Remember startups who are coming to me, 3 guys, and I say, so who has the CM experience? And they go like content management. When you expect them to actually know about contract manufacturing, sort of kills the joy. So it's great that those very specific sort of sectors are now getting taken care of. I will come back to just saying, if you're impressed, and that's the way we look at all those demo day sort of invitations we get. If we're impressed by the mentors and we know that the team managing the incubator is doing a good job, we'll pay attention. Clearly, YC, Techstars, SeedCamp, AngelPad in San Francisco will be the most established.
Okay. And now let's talk a little bit about. Oh wait, Tom, you've got a question.
Can we make this a little bit more interactive? So if the students have a question, well, not
you want us to kind of mix up questions from the students along with.
They have them. I know I have one too. And the thing is, there'll be things that you ask Jeff that will prompt questions, and if you make them wait until you're done with your questions, then we're going to forget what we had asked.
Sure.
Is that all right?
Yeah, not a problem.
So, is this working for you guys? Yeah. Okay, so this has to do with what Jeff was just talking about. Any thoughts about accelerators like, I don't think I heard 500 startups when you were doing your list. 500 startups, Unoodle, Plug and Play is an incubator. It's a real estate play. I think you know all these guys, right? StartX, started by Stanford undergraduates a couple of years ago. Now they've got their thing going. To me, you've had an explosion of accelerators and incubators, and then the question is not just which one's the best fit, but where's the signal in the midst of all the noise? Because there are differences. Part of it might be if you're a clean tech, you're going to go to a different one than if you're doing a mobile application. But among the ones that I mentioned, do you have any sense? I'm not asking you to stack rank them, but do you have any sense of things that you may have seen or might observe from those? I'm particularly interested in Unoodle. Have you done anything with them?
No.
Okay.
And I thought that Unoodle was essentially a way to try and stack rank startups based on some of the fundamentals. I didn't know they were actually an incubator.
They're a global accelerator, so they've got that. There's that other part of it as well. But they're less well known in Silicon Valley for doing that because they're doing it at every country in Latin America and Europe and all that. But being French, I thought you might.
Yeah, I used to be French, but I really don't do anything outside of the U.S.
So, but the more general question is, because haven't you guys seen a lot of? I would imagine no matter where you are at Stanford, there are a bunch of incubators, accelerators that are waving their hands saying, "Come to me, come to me," and you could literally burn 40 hours a week just visiting incubators and accelerators trying to figure out which one to get into?
So I think I'll just come back to that fundamental question, which is who is in the mentor network and what have you heard from entrepreneurs who have gone through the programs? I know 500 Startups pretty well. McClure has been a long-time friend of mine, and we've looked at a number of their companies. And Dave has been really sort of volunteering, bringing a lot of startups, well, not from Silicon Valley, into Silicon Valley to help them sort of get the exposure, which I think is really interesting. Seedcamp is the incubator out of Europe, which is the most well-known here, and we've done a few startups with them because of our focus on the US market, where 80% of what we do is in Silicon Valley, 10% is in New York, 5% is in SoCal, 5% is in Boulder, and the rest is in Europe. We essentially pay a great deal of attention to what's going on here, and to be honest, even though incubators are really important to the ecosystem, only a small percentage of our deal flow and our deals actually coming from incubators. So if you look at the 131 investments we've closed over the past 9 years, I want to say 10, 12% came from incubators. So it all comes down to look at the team, the mentors, the startups which have gone through the incubator and figure out whether this is something that you feel is a good reflection of what you want to be. But remember, you can be very successful as a startup without going through those programs. They are really sort of an acceleration and creating great network, because the power of the Techstars network or the YC network or the 500 Startups network is very real. And so it's definitely an advantage. And figuring out, sort of the dilution. So StartX is an interesting example where there's actually no dilution to the founders, right? So that's a net positive. Are you getting the support that you need? You get, free office space in a really cool building. I know that's where I am. And that has a lot of advantages, especially if you go into non-tech startup, because they do actually, a few non-internet, non-mobile applications kind of opportunities. So you have to understand what that means to be part of the incubator, and you never go in those things without talking to alumni. People who have had a good experience, people who have had not such a good experience. And the first thing you do when you're a founder is you try and talk to your network anyway about all those aspects, whether it's, do I do an incubator or not? Which are the angels I should go to? Should I go on angel list? Who are the micro VCs I should be talking to? Because not every investor is equal. And everyone has sort of certain specific types of founders or sectors that they invest in or they don't invest in. And so you want to sort of try and understand the landscape to make sure that you approach the right people.
I think I saw somebody have a question over here. Yeah.
So this is sort of like after the incubator stage, and it's a little bit more technical, I guess. I find, especially at Stanford, I'm not sure how it is in Silicon Valley at large, that I spend a lot of time fighting this conventional wisdom that convertible debt is a good vehicle for super early stage financing. In particular, that wisdom seems to go largely unchallenged among a lot of students I've talked to, but there seem to be a lot of reasons to be skeptical of that vehicle. Do you guys have any thoughts on whether priced rounds versus debt rounds for early stage companies is a better way to go?
So we get that question all the time, so I'm not surprised. But at the end of the day, what matters is that someone wants to give you money, and then if they say this is using this structure, then you go along with that, because it's not really worth spending too much time trying to optimize one versus the other. So I'll make it easy for you. We always price our rounds, whether we use a debt instrument, which typically makes sense if your round is like 500, and therefore, because a convert note costs like 5K all in, 1% spent in legal fees on the round is sort of fine. But as soon as you go into 750, a million, 1.5 million, whatever, it's just better and cleaner to do a price round using Series Seed, which is sort of a set of documents which are very founder-friendly. That's what people sort of always forget. It's founder-friendly. And use that so you have a really good foundation, and then just move on. It costs you, 25 grand all in between company and investors. So yes, it's a bit more expensive, but you actually get more as a founder, because when you actually do a an equity round, you typically have the lawyer representing the investors doing due diligence and making sure that you have actually filed your 83B elections, properly, that everything is sort of really clean. And trust me, not doing that and just going through a convert note that nobody really sort of does due diligence around can cost tens and tens of thousands of dollars to the company later on. So that's why, for all those reasons, we'd rather do a clean Series Seed investment. And some people sort of try and get uncapped notes. So you invest in a company just on the discount, which means that as an investor, I'm going to help you raise the value of the company, but I will never get the value of that effort. And I will never do it. You might be Steve Jobs. I would invest.
Yeah, and I think the historical context of why people used to do convertible debt was that you had individual angel investors who would put money into a company, and there were just questions around, well, how do we value the company? And which can be a difficult question to answer. So with a convertible debt, you effectively defer that exercise until the company raises an institutional round of funding. Yeah, exactly.
And it's a really good point. I mean, back in the day when I started to invest, so it's 2004, it's true that the angel network that was looking at investing in B2C was essentially 10, 12 guys, and not everyone had enough expertise to actually price properly around and not do anything that would potentially harm the company. That's why we had those notes. But as we've done hundreds of deals now, I mean, we can price, we can do things cleaner, faster, cheaper using equity.
Mm-hmm. Exactly.
If we care to put me on. So I wrote a venture blog post about this. I take a much more crisp point of view about this, which is that bridge notes are a bad idea, that it's not a good idea for the founders, it's not a good idea for the VCs, that capped notes are in fact the worst idea. They create structural problems for startups that are a problem. And so to give you a sense of what that is, essentially what happens is you create a debt instrument that converts at some future price. So you put in $1 million, it's capped at a $5 million valuation, and then someone comes in and funds the company at 10x that, $50 million, right? So you're going to get your shares converted at 5, not at 50, 10 times lower the valuation, but you're going to convert into the same security. In essence, instead of getting 1x preference, you're going to get 10 times the preference, right? So VCs will not view that as an acceptable outcome, that instead of getting 500K in preference, you'll get 5 million in preference or whatever. And so it will require a whole lot of work to fix this problem. So if you have a price that you believe is the appropriate price for a financing, then propose it and fund it, right? If you are an investor, as Jeff says, and you don't put a cap on it, you're just asking the company to make huge progress on your money and then get diluted massively when the financing is successful. I just heard of a company that did this, which had a financing where the company had raised 500K in convertible debt that converted at whatever the next round was, and the next round was done at a 55 million pre-money valuation. So they ended up with $500,000 invested in a $65 million post-money valuation company. So, it's great that you're an investor in this successful company, but on the other hand, you own none of it, right? So if you want to invest in a company, I know, Jeff, that your preference in general is to fund a company at a valuation that you believe to be the appropriate valuation, whatever. It's good for the company. It's your commitment to the company. It's good for you because it's at a given price, and then everybody works hard to then increase the value of the company. So, all right, that's enough of me.
Yeah.
For now.
Let's talk a little bit about the timing of when is the right time to go out and ask for seed funding. So, you're the entrepreneur, you're building your startup. How much progress should I have made by the time I decide, now's the right time to go out and start talking to investors?
So I I mentioned a few minutes ago that you have to understand the landscape and who might actually be a good investor for you, because not every investor is looking at the same things. So soft tech, us first. We typically want to see the founding team having built an early prototype of the service that they want to build, put that in front of users. That could be sort of a few tens of users. If it's a test flight application, it's like 100 maximum, but at least we want to see that let's get it out and get some input, some data, some usage, sort of data points that we can sort of look at. Understanding is very early, but at least we see some of the fire drill, if you want, of the application being in the hands of users. And then we'll want to see that the market opportunity of that product could actually yield a big enough company. And big enough is a very abstract concept. And we sort of have this BS hurdle, which is, what does it take for this company to get to $100 million in revenue? Because typically, if you can get to $100 million in revenue, even though we're looking at 2 or 3 founders and something which has been basically built in the last 6 months or 6 weeks, sometimes 6 days, what does it take for this thing to get to some element of scale? And this is where we get wrong the most, because if ever we don't feel that you can get to scale, then we won't invest. Why? Because we get roughly a few thousand opportunities a year, and we only invest in 20, which means that we say no roughly 99.7% of the time. And so we have to find some elements of filters, and that's the way we do it. And we try and be pretty clear about this. If you go to our website, we sort of explain this. We have this funny thing called the 3 S's rule. Smart-ass team building a kick-ass product in a big-ass market. And that's the way we sort of phrased it. It's actually on the back of the cards with 3 donkeys. It's awesome. But the point is, that's the way we do it. Some other VCs or micro VCs actually will just look at the founders, speak with them, and just bet on them. And it doesn't matter whether you're building product X, Y, or Z and what the potential is. And that's fine. We don't say we're right, they're wrong. It's just we have different ways. Some firms, Sequoia is sort of well known for that, will bet on markets. So as long as you go after a very, very large market, they will be fine just betting on that. So understand the levers of the people you might want to go talk to, and therefore, depending on where you are, you will potentially be too early for us, but you might be fine for another macro VC firm. There is still this notion of the friends and family or the friends and fool round, which is typically you go to people who know you and will bet on you and give you a little bit of money, maybe 50K, maybe 100K, just to enable you to actually build, the prototype, couple of guys paying for the bills or whatever for 6 months, and that's fine. You go to pure angels, because VCs or micro VCs will typically not do those fundings, but it's completely legit to actually go do that. It's sort of an alternative to the incubator. And so the first thing you need to do is to understand, and the way you do that is talk to your friends, your professors, alumni from the school, and so on and so forth, who can actually give you a lay of the land of who's doing what. And you do a bit of research. Crunchbase is your best friend. The public side of AngelList is your best friend, because there's a lot of information which is available to you as to who has invested in what. And therefore, you can start having this short list of people you're going to try and reach out to, and you don't go and contact 25 firms. You start with 5 or 10, try and get to them, do a pitch, figure out how it's working, get the feedback, and then readjust, and then go to the next batch.
So there's this term out there called super angel, and it kind of fits within the whole sort of funding ecosystem. And but I think that term gets mixed up with micro VCs or seed funds. Can you provide some clarity on what exactly that is?
So first, there were the angels. So we were angels, and we're investing our own money. So there's a bunch of us who basically do 1, 2, 5, 10 deals a year. And then in 2000, was that 2006? The article where we got the shot in your office, the photo shot? That was in 2006? Yeah. And so because there were a few people who were doing more deals than others, some journalists had the idea of sort of giving them another name. And suddenly we got bigger wings and we became the Super Angels. That was Business 2.0, wasn't it? And so Business 2.0 sort of figured out like the 13 kingmakers of Web 2.0. So David was one, I was one, Reed was one. And so there was this photo shoot at August that essentially heralded the Super Angels, even though there was a confusion because some of the Super Angels were actually VCs. And so it became like very, very confusing. But those were the people who were at the root of sort of Web 2.0 investing. And then most of the Super Angels essentially became VCs by raising their own funds. And so those funds were called Super Angel funds. And we raised our first fund in 2007. Before that was just my money. And then today, the only real Super Angel that I can think of is our friends, the Ogawa brothers, because they still invest their own money out of, the fund is called Quest VP, sorry, but they still invest their own money. Everyone else has basically become a venture capitalist because they manage OPM, other people's money. So the whole sort of Super Angel thing is completely misused, except in the specific case of Andy and Marcus Ogawa.
So let's talk a little bit about where VCs fit in with seed funds. Because you could go on a bunch of different VC firms' websites, and a lot of them say, well, we'll invest as little as $100,000 into a startup, but
True.
But most of the time, they do only in fact invest at a big Series A or beyond, but there are others that truly do, mostly seed funding of $500,000 to $1.5 million. So, if you're the entrepreneur, how do you figure out, which of these VCs really do focus on seed funding versus say they do, but really do more A and B round type investing?
So the rule of thumb is traditional VC firms will invest, starting at Series A and do Bs and Cs and product acquisitions and so on and so forth. And you have a few firms which are truly doing, thoughtful seed programs that will jumpstart into, or turn into sort of Series and Bs and so on and so forth. The bulk of the market today, the seed market, is really funds which are in the 15 million to 70 million kind of range, which are just doing seed. And then you have a couple of in-between or twinners, like First Round Capital and True Ventures, that have large enough funds to actually do, seed or A. The challenge with seed programs from traditional VCs, which have really been, they really sort of started back in 2008, 2009. There was sort of the first wave, and then others were launched in 2009, 2010, and then, and they sort of build a portfolio of 20, 30, seed investments, and then they have to figure out what the hell they're going to do with them, when they raise their Series A. And the whole point of traditional VCs is that they invested in seed startups for the optionality. Optionality being, if ever I see a tremendously successful seed opportunity, I will jump on it and try and fund it and do a Series A right there and then. So I'm just going to buy a seat at the table with a small 100K investment, and I will do absolutely nothing for it. I will just sit back, relax, and let the angels and the micro VCs sort of do their work. Why? Because as a VC, I am paid to manage the company which I've put in $5, $10, $50 million into, and of course it's more important to me and my firm that that 100K of investment that unfortunately you're running. And so the challenge is you don't want to deal with investors whose reason to get involved in your company is an option. You want people who basically will die if ever you're not successful, sort of die if you're not successful. So really be aligned with you. The challenge that the firms have is that as typically 28 founders out of 30 will get a no, thank you, we won't invest in your Series A. And yes, you can go die in peace, because no one will, because we said no. They start realizing that this is actually bad for them and bad for the ecosystem. And so what we've seen over the past year is a lot of those seed programs to be either unwound or, see the volume of deals that they do shrink dramatically by, 80 or 90%. And to be honest, as much as I love our Series A colleagues because we need them badly to actually mark up our deals and actually sort of take over the sort of leadership and mentorship of the entrepreneurs once we've done our job, which is from seed to A to B to C to D and so on and so forth, is their job. So we need them. But I think that the whole notion of them getting in, at the same level as we did for this option was actually not a smart thing to do.
So let me get this straight. You're in charge of seed to A, and I'm in charge of A to B to C to D to IPO. I'm just curious. I just want to clarify this.
Yep. That's your job. It's always been.
Okay. Good to know.
It's not that we will, and what that means is that we will not, stop taking your phone calls and not help you, and we're still very involved in the company. But the point is that our job, what we do really, really well, is that sort of initial bootstrap phase and getting you sort of to clear the Series A hurdle. And then we'll sort of hand over the keys to David, and that will be sort of his job, and we'll help him, and we'll still be involved when we think we can add a differentiated value. In some cases, there are companies which have invested in them maybe 4 years ago, and I'm still attending the board meetings 4 years later because I'm still sort of adding a value that the current board finds sort of interesting. But in most cases, I will step off the board after 6 months or 12 months of the Series A.
Tom, you have a question?
Given what you just said, what are some of your favorite venture firms to hand over the keys to, and why? And it even can be the level of the partner in the firm because they're. So what are some examples of people like David who you have particularly enjoyed?
So you imply that David is on the list?
Well, I'm not implying anything. He is one of the 13 kingmakers from 2007. So he's saying, hey, I can be there early too. No, but I think Jeff, it's really because the nuances here are really important. Because there are people that these guys think, oh, so-and-so at Kleiner Perkins is really cool, and you're going, that may be the case, but I'm not working with that bozo, right? And this is a game of building trust, that starts with who you're in your seed round with, and it goes to the Series A and so. But I'm not asking you to incriminate yourself on digital, but if there are some investors that you really love working with, that would be, think of it as a positive, and who are they and why? Why do you think they're?
Sure. And thank God he's firm, and he is actually on the list. Otherwise, it would be awkward. But you're making a really important point, which is that the reputation of the firm obviously counts, matters, and it's great to have a Sandhill brand name involved. But you have to really sort of dig in and figure out whether the person of the firm is actually going to be good for your particular startup. And remember, not all partners are equal. And you do have dickheads in some of the top tier firms. And it's a long-term relationship. You're there. You're going to have them on your board, up your ass, for like 5-7 years. And so you want to make sure there is that sort of element of relationship. And don't get me wrong. You want someone who's going to challenge you. You don't want sort of someone who's going to become your bestie and not try and push you. Our job is to get you to perform. And so when you reach the bar and you succeed, we get the bar higher. That's our job. That's what we do. But you want to make sure that this is done with someone you actually can appreciate and enjoy working with. And so to your point, if I look back at the firms we actually worked most with, the number one is actually Foundry Group out of Boulder. Why? Because we're pretty aligned in terms of investment strategy. I think they like what we invest in, and we just have done a large number of deals with every partner of the firm. So all of the guys at Foundry I have 1, 2, 3 deals with, and they're very good friends, and it's a pleasure to work with them. We've done then a number of deals with Sequoia. We've done a couple of deals with August. We've done deals with Greylock. we've worked with the firms that you expect us to work with, and we'll always sort of, the way we approach the next round is we're going to look at a given opportunity, we're going to say, who are the top 5 guys who should fund this company? Are they conflicted? Have they invested in something which is competitive? Unfortunately, that happens, and so you have to sort of chop off that list. And then we go after them. And for some deals, we'll say, like, for a SaaS deal, Byron Dieter at Bessemer will just be the #1 because he's just an excellent, SaaS investor. And if it's not him, it could be Josh Stein at DFJ. But I would not go to Josh for any other types of deals because I don't think that those guys are as good on a pure play B2C thing where if I have a shot, I would go to Reed at Greylock and say, please look at this one. So you really try and understand the team, the entrepreneur, the kind of opportunity they're working on, and what the firm wants to do. I had that very conversation this morning with one of my investments. Those guys are absolutely crushing it. And which means 5x from last year's revenue, which was already double digit. Yeah. The question is, who actually takes a deal like that and invests $50 million? And we actually went through a list, which was on a Google Docs spreadsheet, to figure out what firms, what were the 5 we should actually go talk to first, because there isn't that many people who have both the cash and the guts to actually do this kind of investment. So you really want to sort of sit back and think about the partner and the track record as you approach this. And typically, your existing investors will help you. It has to be a very organized process. The thing which irritates me the most is when you have some random angel starting to make intros randomly to firms which are definitely the wrong one, because it's kind of cool for them to show off their portfolio. It's just not the way things are done.
Okay.
How competitive is the micro VC landscape? So Mike Maples, you, and I mean, those are the 2 prominent ones, but in your view, is it getting more competitive, or do you think you all have like a huge moat?
So, and I really mean it, I don't see us as competitive at all. And it's, because we've all sort of been working together from way back when. I mean, my first investment with Mike was in Congregate back in 2005 or 6. And so we've all sort of evolved with our firms at the same time, and we've done a bunch of investments. We all have our hot buttons and hot sectors, and Mike has done a few really sort of interesting deals out of pure academia with Anne. And to be honest, I don't know what I would do with those deals because I don't even understand what the hell they're doing. And we showed them a couple of deals we've done in EdTech, and they were not interested. And so everyone has sort of a set of sectors or favorites that they would sort of look at, which means that if you look at the landscape of 25 or 30 macro VC firms, there isn't like a 100% overlap as many people would I think, expect. The other thing is, we've been around for almost 9 years now. We have a pretty good track record. We have, I think, pretty good reputation with our founders to really do a lot, as much as we can, to support them. And so if ever an entrepreneur has to make a decision between us and others, then they will figure out what they'll learn by doing due diligence on us as to who is the most appropriate investor to take money from. And to be honest, there are types of deals where we should just not be on top of that list. I remember when you guys did WePay a few years ago, and I really liked the guys, but everyone in the syndicate was ex-PayPal, and I'm not. And I told the founders, you're going to tell me that you like me, but I can't invest because I don't have a payment experience. And they were right, because they didn't have a payment experience, and everyone in the freaking syndicate had. So in that case, I can't blame them for not having taken my money. So I think that because we're pretty disciplined around valuation, there's also sort of a natural self-selection here, where if we think that you're worth this, we might go there, but we won't go there. And so some high-profile sort of YC deals from the last batch, for example, Zen Payroll and Codecademy, where we were the first term sheets on, we just passed because they ended up being super expensive. I'm not saying that they were not worth that. I'm not. I'm just saying that I wasn't willing to pay that price. So if you start, adding everything up, I would say 99, maybe once or twice a year we end up trying to invest in a deal and we just can't, which, is fine.
So Jeff, I just have one last question. There's been a lot of talk in the press lately about the Series A crunch, right? Which is all these seed-funded companies that are supposedly going to have trouble going out raising Series A rounds of funding. What's your take on that? Is it really as big a problem as the press makes it out to be, or is it just kind of the natural life cycle of startup funding?
It's definitely, it's real, it's definitely there. And you guys are really smart, so it's basic math. You have, 50 firms that are doing a few Series A's a year, and they have a certain sort of budget or allocation or funds available for that. And that number has been staying pretty constant, and maybe actually it's decreased because there's been a contraction of the VC market. So there is a certain pool of capital available for Series A's. Over the past 3 years, we've seen a 2 to 3x increase of the number of companies which were seed funded. Why? Because it's easier, it's cheaper, there's a bunch of incubators, there's a bunch of angels, there's a lot of money, there's a lot of excitement, there's $1 billion outcome for Instagram. And so you have a literal explosion of the number of seed deals while the number of Series A's, potential Series A's, is staying constant. And actually, the size of Series A's is actually increasing, which means that the number of deals which are funded with that pool of capital is actually decreasing slightly. So what do you think happens? It's not so much that there are less companies that are getting funded per se. It's that the percentage of companies which are getting funded actually shrinks because you have so many more companies in the funnel. And so the crunch is not really a crunch. It's just a steep funnel where only on a relative basis, I don't even know what's the percentage, but 20% instead of 40% of the companies will be funded. And I actually don't want to be held to that number because I don't know what the number is. But it's kind of the idea. Just have a funnel which is much higher and there's just so much capacity. The issue, what's happening today, is there is so much activity from seed to A that David is just inundated with opportunities. And he has one of two things to do. One is just sort his funnel by the people he trusts the most and only sort of look at those opportunities, or try and see a lot more, but then have a very short time he can actually spend per deal to figure out whether this is something for August or not. And the issue with that approach, I actually don't know what you guys are doing, but that's what a lot of people are doing, not spending that much time with a bunch of opportunities, is that complex deals, things which aren't obvious, will not get funded or might not get funded. The crap won't get funded. Great deals will get funded. It's this sliver of kind of not obvious deals that will have an issue. And that's where we need to support them. We need to sort of bridge them to hopefully get to the point of being more obvious. And I don't whine, I don't complain. It is what it is. That's the reality of the market.
Yeah, I was talking with someone this morning about this phenomena, and I think it'd be interesting to see what you think, Jeff, but I think that over the decade and plus some that you and I have been in and around these markets, the number of interesting businesses has been relatively consistent. It's kind of X plus or minus, 0.2 or something. It's basically the same number of companies that will be interesting in a year exist. And what changes is the number of not interesting deals, right? So in a frothy market, in a well-funded market, you'll have 5x the number of deals that are not likely to be funded, but you need to sort your way through them. But ultimately, the same number of companies are going to get funded, are going to be successful, are going to grow, plus or minus a little, right? And so for Jeff to figure out what those are going in, and for me to then be able to sort through them, that it is my job. That is what the two of us do. But the byproduct is that in frothy times when things are overfunded, you'll have 5x the number of companies that go unfunded, and that's just where we are right now. I'd say my system is much more about introductions, right? I mean, you tell me to look at a company and I look at it. That's, others, you get other stuff sent to you and you say, maybe not, right? And that's, I think you have to. I mean, unless you have an infrastructure of minions, you have to use a filter, and the filter is people.
Mm-hmm. I think that it might be more obvious to you guys at your scale, but if I was to sort of project the winners in a fund early and then the same winners 3 years later, it's actually interesting to see that some are still there, but some have actually dropped, and others that you were not seeing as obvious, because there's always sort of the ugly ducklings that no one wants to touch, but is actually doing, okay, and then well, and then suddenly they explode, and you go like, holy crap. And it actually happens for us in a seed portfolio where, especially Fund 2, where we now have quite a bit of data because it's 5 years old, the top 5 of the first 3 years and the top 5 of right now only have like this, 2 companies out there, but 3 have actually changed, which is kind of interesting.
I think that's all the time that we have for our discussion. Oh, okay. All right.
Rick?
Thank you. I just had a question too in terms of, since the number of fundings have increased on the seed stage, have you also seen the number of smaller acquisitions increase by the same amount?
I wish. No, it's basically decreased because, well, it's pretty simple. You have hundreds of companies which are going to try to find a soft landing because they can't find, investors to actually either put more money into the company or, someone to actually pick up the tab for the next round. And so the Twitters and Facebooks and Dropboxes and all those guys are just inundated with, hey, can I introduce you to that team? They're pretty cool, whatever. And in an environment where there is a shortage of talent, yes, you can find, ways to sell your engineers, but where a few years ago you could actually make close to $1 million an engineer if they were really good, and you ended up making money on a failure. Right now, as an investor, you're basically told, look, there will be nothing for the investors, and here is the deal for the developers and the team. And to be honest, it's not even as good as if they were actually trying to get a job at the company directly, which is sort of ridiculous. So there's a lot of acqui-hires, going on, but what you hear about is actually a very small percentage of the number of companies which will just flat out just disappear. Because the last thing I want is to try and force one of my founders or teams to stay at Facebook for 3 years because I'm going to get 10% of my money back. Because that doesn't matter. I don't care. Because for me, losing 100% or 90% is exactly the same thing. And therefore, I'd rather sort of set them free and just be the good guy, as opposed to trying to get like a little bit of money back, which and really doesn't make any difference. And to be candid, acquirers understand that mechanic anyway.
For more, please visit us at stanford.edu.